Greetings, this is Chapter 7, Video 1. Let's launch. All right, so today's class we're going to learn about an introduction to investments, and then we're also going to talk about how investment income and dividends income is actually taxed. It's going to be, I hope it's going to be a little bit of a short video. Maybe if I pontificate a little bit too much, we'll see if it gets longer. But anyways, so investments overview. So we have the before rate of tax return on investment, and then the after tax rate on return of investment is going to be a big deal. This is something that sometimes your clients will help you actually try to calculate. For the most part, I don't think you're going to have too much in terms of in calculations of that. Now, if you get into, a lot of CPs are actually being pushed into wealth management. Initially I was dead set against doing it. I'm starting to see some value in that personally. So there's a lot of people who that's what they end up doing, and so that's where they go. So that's when you kind of take a look at this, but it also depends. So when we take about after-tax rate on return of investment, depends on when investment income is taxed, and it relates to tax planning strategy. So for example, if you buy an investment, you don't get taxed on the gains of that investment until you dispose of it. So there's a little bit of tax planning that ends up happening as a result of that. And so as a CPA, you'll have to worry about that and work with people on that. So it depends on the rate at which income is taxed. Relates to the conversion tax planning strategy. So, again, there's certain timing aspects of things. When do we want to dispose of things? But then also, how do we want to dispose of things? And so in certain things, like, for example, stocks and bonds, there's really no option. You're going to dispose of it the way that the tax law is pretty much set up. I mean, you buy and you sell it, and that's pretty much it. You can't do 1031s on stocks. You can't do a whole lot of other things with stocks other than donating them. Which actually is a good tax planning strategy, and you can work on that. But again, that's going to be some of the big things that you've got to worry about. Portfolio versus passive investments. So portfolio losses are deferred until investments are sold. Passive investments may be deducted annually. So losses may be deducted annually. It depends. So we'll talk a little bit about this when we get into rental real estate. But the big thing is that if you have passive investment losses, there are certain limitations, but generally, and we'll talk about the three buckets. And I have a really good video series that actually talks about those three buckets if you really want to get into it a little bit more and understand it better. And I'll be happy to share that with you guys later on. So interest and dividends are usually taxable when received. Now, I want to stop there for a second. I can't tell you the number of times that I have clients who come to me and say, I receive no money, I don't pay any tax. And they think they don't receive any money, but they did. Okay. A very common thing that happens is you have clients who are going to invest in, they're going to have a portfolio account. They're going to have an investment account with a broker. And they tell the broker, okay, this is the kind of investment strategy that I want. And the broker says, okay, fine. Do you need the money now? No, I don't. I want it to grow. Okay, fine. So as these stocks and bonds pay interest and dividends, I'm going to take that money and reinvest it for you. Okay. So when they take a look at their stock statement and it says $17,000 in dividends, the first thing that goes to their mind is, what's $17,000? I didn't get paid any dividends, because they're not seeing that in terms of do, re, mi, emphasis on me. They're seeing it in terms of an increased stock portfolio, but they're not seeing even that either, because they're assuming that's just because of growth and investments. This is a conversation you'll have to have with your clients. Yeah, you may not have gotten the money, but what's going to happen is that you reinvested it, ergo, you get taxed on it immediately. That's the way the tax law works. And they'll argue with you on this, and they'll say, well, I didn't get any money, but I bought something else with it. I said, so let me see if I got this straight. So if I pay you $17,000 in dividends, but you go out and you buy a car, you still have a car, right? And they're like, well, yeah. I said, so you got something of benefit. Yeah, but that's not the case here. I bought more investments. Well, guess what happens? When you sell those investments at those higher prices, you're going to pay less in taxes. Oh, okay. And usually when you have the conversation with your clients like that, obviously I do it a little more professional than I've done it with you guys. That's how that kind of works out. So interest from bonds, CDs, and accounts, they're going to be taxed at ordinary income rates. unless they're municipal bonds, at which point, as we talked about in a previous video, they're going to be exempt from taxation. U.S. Treasury notes are not taxable by states. That is due to a separation of federal and state government issue. It's been litigated in the courts, and that's how they came to that conclusion. It's not like the states all got together and said, "Yeah, we don't want to tax this income." It's because it's basically because the courts came down hard on them for doing so due to that, and as a result of which it's not taxable. Okay, so if you have treasury bonds, and treasury bonds can be savings bonds, they can be all sorts of different types of bonds. You can buy mutual funds, then invest in nothing but government stuff. And when I say government stuff, I'm talking federal government stuff. Those are going to be exempt at the state level because it's U.S. Treasury bonds interest, and therefore it is deductible. Is not taxable on the state income tax return. It will be on the federal return, but at least your state tax returns will pay less. So dividends on stock usually tax at the preferential capital gains rate. I want to talk about that for a minute. What makes a stock taxable at preferential capital gains rate versus ordinary rates? And that is if it is a U.S. company or a company that the IRS has deemed to be a U.S. equivalent, they're going to let you have preferential capital gains rates. And generally speaking, if the country has a tax treaty with the United States, the IRS has specifically identified those people as being preferential capital gains rates. So for example, I invest in a company in Germany. It makes $10,000 in dividends. I get taxed at 15% here in the United States on it. I'll probably pay 40-50% in Germany because that's how they tax their income over there. But here's the best part. If I pay taxes in Germany, I get a foreign income tax credit against my income tax here in the United States because I've already remitted some money to Germany. So it can be actually a pretty good deal in that sense from a U.S. tax standpoint. Obviously, paying 40-50% on your taxes in Germany would not be a good deal. But at the same time, if you invest in a German company and it's a good company, it makes you money. Again, will I take $1 if I'm going to sacrifice 40 cents? Absolutely, because I still get 60 cents in order to go play with. All right. Why invest in assets yielding interest or dividends? There's non-tax factors, so there could be an overall risk factor of it. So if I invest in a company that, say, for example, AT&T has been here for 100 years, probably going to be here for a couple hundred years more, minimum. Not even the death of the telephone has killed AT&T. They merged themselves into something else, and that's kind of the thing. IBM, which I thought was going to be a steadfast company, old Big Blue as they call it, they've even weathered some storms and they've made it. Okay, so there's a very low risk factor for some of those people. Now, little corporation over here down the street that makes probably around $7-8 million in revenue, but pays out dividends, there's going to be a higher risk involved with that. So there's going to be a diversification of that risk. And this is really not our area to talk about. Again, I talk about swim lanes. This is not our swim lane. We don't talk about this to our clients. Usually risk and diversification should be talked to by their financial planner. But if they don't have a financial planner, or if their financial planner is not doing their job, you mention this to them. You say, your stock planner should be talking about diversification of risk. If they're not doing so, get on one of your financial planners. This is where you need to build your network to be successful, folks. If you want to be very successful in the tax world, you got to build your network in order to make things happen so that you can get other things to succeed. Other non-tax factors, there could be all sorts of things. I remember when I first started getting into investments, my broker at the time was telling me about a person who asked him to purchase one share of Harley Davidson, only because he wanted that one share of Harley Davidson. There's lots of reasons why people do investment things, but he wanted it because he loved Harley Davidson and actually drove a Harley, and so that's what he wanted in order to do that. All right. Qualified dividends. Dividends must be paid by domestic or certain foreign corporations. We already talked about that, subject to preferential rates. 15% or 0% if you're below the 0% maximum. So if you're in the first two tax brackets, and I'm looking right now at my trusty Quick Finder, and it says that if I am under $78,000 married filing joint, or if I am single under $39,475 for the tax year 2019, I will be in the 0% tax bracket for preferential treatment. So you can get 0% interest on qualified dividends. Pretty good deal. I mean, not very much out there comes with that kind of a deal. Now, more often than not, if you're retired, you're probably not going to be in that category. You're going to have all this other stuff that's going on that that's going to cost you on that. So, and usually very low income individuals don't have this because they don't have the ability to save the money. So it's not going to work out too often. But anyways. So, and then they kind of talk about subject preferential rate. They also talk about the after return rate, which is something that you do need to take into consideration if you're a financial planner, not so much for the tax size. Non-qualified dividends are treated as ordinary income. So if you buy stock in some country where we don't have a treaty, for example, I'm just thinking of somebody right off the top of my head. I'm not trying to pick on anybody, but like, for example, we don't have a tax treaty with the country of Gabon. I've actually been to Gabon. Gabon's a beautiful country. I love it, but no tax treaty. Why? Whole host of reasons, I'm sure. But we don't have a treaty with them. So if I invest in a corporation in Gabon and it pays a dividend, guess what? I don't get to take that as a preferential capital gains rate. So it's going to be taxed as ordinary income. Okay. All right, so that's all I got to say about that. I want to say thank you very much. I want to say glad to have you in class. I'm looking forward to seeing you in the next class.